What's up, good people? My name is AJ and you are watching Straight Talks. Like the title says, the video here today is going to be reacting to one of my subscribers' portfolios. This was generously submitted to me for the purposes of this video by one of the subscribers, and depending on if you guys like this video, I might do similar ones in the future. I'm going to show you all what the portfolio looks like and then point out some of the first things I noticed when I saw it for the first time. Then we'll dig into a little more of the portfolio characteristics using a couple of the more popular portfolio diagnostic tools out there, one of those being BlackRock's Aladdin. And then I'll give you a couple of my opinions on where the portfolio aligns relative to what you'd typically see out there in the industry. Keep in mind, I cannot give any specific investment advice over YouTube or through most other mediums for that matter, so I'm not going to share any of my thoughts on if I think these are good or bad positions or anything like that. Rather, where I think these fall relative to how most other folks and most other institutional investors would structure a portfolio. Here is what it looks like. Feel free to pause the video over this screenshot. Right away, I wanted to commend this person for what looks like some of the work that they've put in to come to this portfolio. They have 10 different positions here, and choosing your own individual investments is never easy. It can seem like a daunting task, and it is definitely that for a lot of people. So it seems to me like there was some thought and consideration put into this one. It looks like this person was working towards diversifying their portfolio and trying to maximize where they land on the efficiency frontier to get as much return as possible while minimizing the risk they take. Here are my initial impressions when I first saw these positions. These are all indexed funds, and like Warren Buffett, I would argue that for most people, using an all index fund portfolio is the best way to structure your account. Not because those investments are necessarily better or worse than any others, but just because they are more simplified. And it's shown time and time again in studies that when people feel like their investing has been simplified for them, they are far more likely to actually participate in using those investment accounts and therefore build up their assets later on. So indexed funds are a good option for a lot of people. That's what is being used here. For certain asset classes though, I usually argue against index funds. Specifically small caps, mid caps, and emerging markets are three areas where active management can almost outperform more than half the time depending on what time period you look at and what studies you're citing. About 1/3 of the companies in the small cap index, like the Russell 2000 in the United States, have negative cash flow right now. So right away, if you just took a smart beta or semi-active approach and ruled out any small cap stocks with negative cash flow, you might agree that that could potentially improve your returns over longer periods of time. With mid cap stocks, I think those have actually been shown to be the category that active management can be most successful with. And then in emerging markets, you know, the indexes can be so huge there. You hear from emerging market investment managers that send their analysts over to these places that are, you know, maybe $25-50 million businesses in annual revenue that have never had a business analyst talk to them or had any investors be involved in their stock. So you can really find some diamonds in the rough in emerging markets, and that's why I think active management can work better there too. Second point is that these are all Fidelity funds. Now that's good because Fidelity is relatively cheap in terms of their expense ratios in their index funds compared to some other issuers out there, but I usually would lean against putting all of my investments into funds through one fund family. If you're gonna do it though, Fidelity is one of the more secure fund families out there, so you don't have any major concerns with using Fidelity funds. I just mean to say that as well as asset class diversification, there's an argument to be made, and some people would make this argument, that you need to diversify the fund families that you're using to invest your dollars with as well. Third initial reaction was that this person holds much more mid and small caps, which is about 45% of the portfolio, relative to large cap stocks, which are about 30% of the portfolio, and that is very unconventional. In my career so far, the only instances in which I've seen a diversified portfolio hold more mid and small caps relative to large caps is when the manager is literally a small cap or mid cap shop, and they are targeting a certain cap size because that's where they feel that they have a competitive advantage towards picking stocks. And so just from their own resources, they wouldn't allocate as much time or energy into buying large cap stocks, but that's not even exactly a completely diversified portfolio anyway, so it's pretty uncommon to see someone leaning more mid and small right now. That has been especially true in 2019 and 2020 when large cap stocks have dominated the indexes. I mean, Apple, Amazon, Google are like some of the best performing names out there, and I know there are some really boutique names that have beaten their numbers, but relative to the amount of size that those positions hold in the index, and considering how well they've done, that has caused large cap stocks to just greatly outperform mid and smalls in the last 2 years. Now, if you look at the last 100 years, mid cap stocks and small cap stocks usually beat large cap stocks. It just hasn't been the case recently, which is why I think it's becoming more and more uncommon to see a portfolio like this that's more weighted towards mid small cap stocks. If you ever think that this trend will revert and small and mid cap stocks are going to become the dominant performers relative to large caps again in the future, then this portfolio might work out really well in that scenario. Now, for a more detailed look, here's a quick screenshot of a Morningstar report that's showing an overview of some of the characteristics of this portfolio. Probably the most surprising point there is the underperformance relative to the benchmark that you're seeing on that chart in the upper right hand corner. That's not a totally fair comparison, and I'm going to get into some of those details later on, but for right now, check out this other chart. These Fidelity Index funds are showing that they have relatively high correlations to one another. The Emerging Markets Fund used in this portfolio is about 90% correlated to the International Small Cap Fund that's used here. And the Mid Cap Index Fund is like 96% correlated to the Small Cap Index Fund used here. With these 2 points and a couple of the other similarities between like what's going to be some of the mid cap positions to what's going to be some of the large cap positions, effectively what you have here is about 60% of the portfolio split between 2 types of holdings. This just isn't ideal because, of course, if the indexes that these 2 types of holdings are most correlated to, being like mid-cap index and emerging markets index, perform relatively poorly to any large cap or bond indexes, then that's going to adversely negatively affect this portfolio. It doesn't have a lot of diversification in that sense because it's going to be so tied to those. Ideally, you'd have like 2 mid-cap blend funds that maybe one is indexed and one is actively managed, and they have relatively low correlations to one another because they are using different strategies to select which mid-cap stocks are in them, and so therefore there are different portfolio characteristics or something like that that gives you more diversification than this has. Back to that underperformance that I talked about though relative to the benchmark, it's only because of the real estate fund that is listed in this portfolio, and for whatever reason, the Morningstar software I used did not automatically benchmark 10% to a real estate index in the comparison it did. It just used like some random value stocks. So those have recently been performing much better than real estate, and so it shows this portfolio losing to the benchmark. Not a totally fair comparison. Now, I'm not saying that real estate is either good or bad in a portfolio, and it is pretty typical to see like a 5 up to 10% allocation, which is what we have here, in a portfolio to real estate. Just know that you're getting exposure to an index that has a pretty high standard deviation, meaning a relatively high risk profile, almost as high as that of the stock market indexes, but doesn't have, at least over the past 10 and 20 years, as high of an average annual expected return than stock market indexes do. Here are a few really cool hypothetical scenarios that you can apply a certain portfolio to, and I'm guessing a lot of people don't have access to this type of thing. It's powered by BlackRock's Aladdin software, so there are some assumptions built into that they use, but it's based on a huge amount of big data from what I understand from BlackRock. So this is going to show you what this portfolio may have done in a few different scenarios. Feel free to pause the video here. The biggest surprise to me here was that in the crash of 2008, this portfolio would have only lost about 29%, whereas the large cap stock index in the United States lost, I think, 54, 55% during that same period of time. So that's almost only half of the downside, even though it's a 90, 95% stock portfolio. That's just due to the overweighting to mid and small caps here. Mid and small caps did not do as poorly as the large cap indexes, specifically the finance sector in the crash of 2008. So if a similar scenario like that came up once again, this portfolio would greatly outperform the S&P 500. I'm concerned by the fact that this portfolio could lose 10% if high yield spreads were to widen by about 30%. This basically means that the interest rate on high yield bonds would be increasing. That usually results in a price decline of high yield bonds. There are several other effects that this can have on the economy, and you can look all into how high yield spreads widening can affect different facets of the economy, but in my opinion, you don't really want to see a potential loss of this size just from an event like that. So I would be looking into like what exposures this portfolio has to high yield bonds. Some of that's probably through the real estate holdings. A couple other points. This person has a bit of a value tilt relative to a growth tilt, meaning it holds more value stocks than growth stocks right now, which is pretty uncommon given the times. It's not huge. The only overweighting is through, in the small cap space, they hold a small cap value and not a small cap growth fund. But in general right now, most portfolios you see are going to have a bit of a growth tilt, if not an equal weighting to growth and value, because growth has been dominating value in terms of performance over the past 6 or 8 years at least. And especially like in the last 18 months, at least as of the fourth quarter of 2020. Now, when you compare the relative performance of growth versus value over like the last 100 years and you chart it, growth outperforming, value outperforming, whatever, we are now past the previous all-time highs in terms of a discrepancy in the performance of those two, meaning growth has outperformed value by far more than either of those two have ever outperformed each other in the past. So there's an argument that's made really commonly out there that value is going to come back into favor at some point. Growth stocks will no longer continue the huge run that they've been on for the past 10, especially 2 years. And this portfolio would stand to benefit a little bit from that because it has a slight value tilt if value stocks came back into favor. In summary, it looks like this person has put a lot of thought into the portfolio and it's pretty well diversified because of that. Depending on their goals for this account, they may be able to optimize a few things based on a couple of the points I've mentioned here. If you have any other questions for me or for the person who gave me this portfolio, feel free to leave those questions in the comments down below. They may respond to those, otherwise I can get back to you on some of my thoughts. And as always, thanks for watching.